welcome to our AIM Summit webinar. I'm Zachary Seferati from Dalma Capital. It's so great to have you here with us today. We're going to be discussing unique market dynamics in private credit post-COVID-19 with a focus on Europe and Asia, discussing untapped opportunities and unforeseen risks. I'm so pleased to have this session sponsored by TICO Capital and as a strategic partner with us, KHK & Partners. We have people attending this webinar from over 30 different countries around the world. It's such a pleasure to have you all, institutional investors, family offices, here to learn more about what's happening in the private credit markets. We're going to be focusing on the implications of COVID-19 for the European economy and how that's affected the private credit markets. We're going to be talking about the market dislocation and the opportunities that that's created in these markets. We're also going to be talking about a background on China's credit markets, the emergence of China as the second largest market in the world. We're going to be talking about the creation of 3 waves of NPLs, where we are now. Is there going to be a Lehman moment? Why or why not in the Chinese credit market, as well as what the opportunity is there. We're going to be starting off the webinar with our guest, Peter Cerenza from TICO Capital. He is the head of United Kingdom and the chairman of private equity and special opportunities business units at TICO Capital. He was previously a partner at Goldman Sachs, where he worked for over 20 years in New York, London, and Tokyo. He helped to develop and lead the firm's proprietary special situation investments activities in North America, across Europe, Asia, and also has significant experience in mergers and acquisitions as well as structured finance. He's been a lecturer in economic history at the London School of Economics and Political Science since 2009. We could not have a better expert on the European credit markets private credit markets with us today than Peter. It's such a pleasure to have you with us, Peter. If you could please tell us, what is it that you're seeing? Love to hand over to you for your keynote session today. Actually, before I hand over to Peter, just to let everybody know, there is a live Q&A. Feel free to ask questions as they come anytime. We will address the Q&A session at the end. After Peter's keynote, I will be handing over to Ben, but we'll have a Q&A for both Peter and Ben, so feel free to ask as many questions as you have, and we're going to look forward to addressing as many questions as we can in this time. But without further ado, such a pleasure to have you with us, Peter, and thank you for joining us.
Excellent. Well, Zach, thank you very much and for that very kind introduction. And good afternoon, good evening, good morning, everyone. I hope everyone is doing well in these very challenging times that we're all living through, very strange times. I thought what I'd do maybe is just give you, just a very quick, for those of you who aren't familiar with TICO Capital. So TICO is an alternative asset manager, very focused on investing in European markets, 25 billion in AUM, 3 billion in shareholder equity, significantly owned by management. So we have a very, very strong alignment of interest between managers and our LPs. We're active across a range of European markets and very focused in private debt, in real estate, private equity. So that's kind of the background of TICO, right? In terms of the market opportunity and where we are, I think maybe just a quick backdrop. We've had this very, very extraordinarily quick financial crisis, or transition from a health crisis impacting the real economy and impacting financial markets in just an unprecedentedly quick period of time back in February and March. And the speed of credit downgrades, the speed of deleveraging, of repricing of financial assets was incredibly quick. We've then had, subsequent to that, a very, very strong and quite impressive rally in equities and credit, significantly aided, of course, by the words and actions of central banks around the world. And then the question is, okay, so where do we sit now? Will this very strong rebound hold? I think my own view is that it won't, that we will see further significant volatility the damage, unfortunately, that's already been done to economies by the virus, and more importantly, by containment measures, will undoubtedly weigh on the subsequent recovery. It's really a period where, due to the income support programs in many countries around the world, and certainly in Europe, that unemployment has been significantly masked in the short term, but we are unfortunately expecting to see very elevated levels of unemployment, very much on par with what we saw in the global financial crisis. And I think, unlike the GFC, one thing that's different about this particular moment is that this is quite a global event, whereas the GFC was very much a developed economy event for the most part, significantly bailed out by ongoing growth in developing economies. Here this is hitting obviously everywhere. Certainly the markets are quite optimistic at present, and there's a lot of discussion about, are we going to have a V-shaped recovery? I think in my mind, I think we're probably confusing recovery with rebound, right? We certainly have had a rebound, but the notion that we're going to return to sort of the pre-COVID levels of economic activity in the short term, I think is unlikely. You have the OECD, anticipating very significant double-digit declines in GDP in developed economies in 2020. You have Airbus saying that air traffic won't return to 2019 levels until 2023, right? We have a lot of sectors, airlines, aerospace, energy, hospitality, tourism, restaurants, leisure. All these segments are going to have significant uncertainty and revenue loss for an extended period of time. Any activity where people are congregating indoors is significantly impacted, and obviously you have not just the current government restrictions, which are themselves kind of coming off, going back on, depending upon the transmission of the virus in different places. But you also have the uncertainty around that, and then you also have the impact of how will this change consumer habits, right? And so I think all of those things suggest that the recovery we're likely to see will be, maybe a bit like a Nike swoosh more than a V, and with potentials for setbacks, setbacks along the way. Right? I live in London. Pubs opened on the 4th of July, and the first weekend's reports were actually pretty negative. From a social distancing perspective, not ideal. Not easy to keep people socially distanced despite best efforts. But the economic feedback was quite mixed. It's higher cost to operate in the new environment. Revenues were down. There were many pubs that didn't open. And so, notwithstanding 3.5 months of pent-up demand of Londoners and people in the UK wanting to go to pubs, the feedback, the initial feedback was not terribly strong, and so I think that's a bit of the environment that we're looking in. So to me, I think we have a pretty meaningful gap between the technicals of where assets are trading versus the underlying fundamentals, and so I see more dislocation coming. Q2 results will be very poor, obviously, for many businesses. So I think all these things will eventually weigh on the markets, notwithstanding some very, very powerful words and actions by central bankers. Right. So in terms of where we see opportunities in Europe, TICO is focused both in public markets and in private credit markets. On the public side, as many of you will know, there was a very short but very attractive window, kind of late Feb through mid-March, where you had very significant dislocation, forced selling, a lot of very good assets traded down for no particular reason other than people needed liquidity. And then we had a very, very sharp and quick recovery. But we expect there to be another correction phase, and we certainly think that there is going to be more opportunities in the sort of the stress secondary aspect of the markets. and that's an area in which we are, looking to be active, well positioned. But obviously, prices at the moment are not particularly interesting. The other thing to say about the private credit markets is that we've seen a very big increase in our own pipeline of transactions that we're evaluating. Kind of the overall universe of stressed and special opportunities investments that we see in Europe has basically doubled since the start of the year. So that's quite important for us. On the public market side, again, I think we're expecting another correction, and I think the key there is to be able to be able to discern and separate businesses that were unfairly sold and are just mispriced, or businesses that we expect to rebound versus those that we think are more fundamentally impaired. Do the work, be ready, have good market access, because liquidity is not always easy. You can certainly identify and see bonds and loans priced at attractive levels. Being able to aggregate positions is a bit more difficult, and that for us is really the keys to generating strong returns in that segment. And returns certainly in the March period were very, very strong indeed. On the private market side, we're getting lots of requests for rescue financing and people looking to address liquidity needs. Certainly, a lot of the early borrowers were either cyclical businesses or businesses that were heavily impacted by the virus and more importantly by the containment measures. For us, from our perspective, we're not really in the business of making bets based on the efficacy of either treatments or a vaccine or the timing of such and the availability in large numbers of a vaccine and the impact on containment policies. So we would avoid taking positions in businesses where you're really effectively in that vein. I think probably all of us have become sort of amateur epidemiologists in the recent period of time, trying to understand the transmission of the virus, its impact, how it can be mitigated, et cetera. Obviously, virtually all of us, certainly I am, not remotely qualified to have an opinion on that, but we're all obviously have been strongly affected by it. So we're going to try to look for situations where there are resilient businesses that we think are just fundamentally mispriced in a period of time, or where we think we can be well compensated for providing liquidity to businesses or helping to repair balance sheets. Maybe a quick word on the government response, particularly on the fiscal side. Again, unlike the global financial crisis, what we've seen, which I think is quite a positive for all of us, is governments have been much quicker off the mark in terms of a fiscal response, whereas following the GFC, there was a lot of concern about ballooning deficits, et cetera, and austerity and so forth, and you had very much a monetary policy response to the crisis. But here you've had a lot of very good support programs that have been put in place. The loan guarantee and loan programs in various countries have been generally really well designed, and though not perfect, have been very effective. They've been administered through the banking system, and the level of guarantees in Europe vary based on the size of the company, whether it's based on employees or turnover or size of loan. And I think that these have served a critical function in helping companies to deal with significant and fairly immediate revenue loss and provide liquidity. So for example, in France, they've got a very good program where the loan rate is set at basically the bank's funding costs, pari passu with other creditors, quite flexible, no amortization for 12 months. and then the borrower can choose maturity up to 5 years. And there's been very good take up on this program, and it's been very effective, for example. But I think the other message to deliver, is that notwithstanding these various loan guarantee programs, income support programs, very significant quantitative easing that we've seen from central banks, that that there's still a very substantial opportunity for private credit providers in the markets. There are certain types of companies that aren't eligible for these loans, and in some cases the loans require quite complicated negotiations around covenants and other terms with incumbent lenders, and then there are cases where you have companies that ostensibly look to qualify, but there can be delays and uncertainty around the availability of these loans, which can lead companies to require alternative and supplementary forms of credit. So in this sort of environment, which if anything has gotten even more complex, right? Complex in terms of capital structure and the role of the government's loan guarantees, and then the complexity of the impact of the virus and containment measures on different sectors, and clearly in that context, you have some sectors that have done quite well. All of us wish we were long, Amazon, Zoom, Ocado, et cetera, in January. And then you have, segments that have been hit very, very strongly. And then you have a lot where it's going to require some real good credit judgments about what companies to finance and engage with, and on what terms. And then, of course, the government loans that have been extended will need to be repaid. And so the opportunity that we're going to see I think is going to be quite a long dated one, and it will play to the strengths of firms like TKO that are very well situated and active in providing credit to businesses in Europe, and again, we expect to see opportunities for many years on the private credit side. And maybe just a quick word on real estate. We're also active as a real estate secured lender, and certainly in this area we've seen a flurry of requests for bridge loans and liquidity and refinancing needs of borrowers, and we've seen it really across quite a broad range of asset types and a broad range of geographies across Europe. I think in this segment we are quite wary and careful about sectors that are experiencing quite severe impacts on rents, so and income. So certainly the obvious ones: retail, office, leisure, hotels are all segments where we're treading quite carefully. The other thing we've seen in the real estate sector is a several hundred basis point increase in the pricing that's available in this segment, and so we expect, alongside of the private corporate lending opportunity, that the real estate secured opportunity we expect to be quite well compensated. We expect that opportunity to exist for quite some period of time across a range of geographies. So Zach, maybe I'll stop there and I'll turn it back to you.
Thank you, Peter. We have some excellent questions coming in on the Q&A. I'm really looking forward to coming back with a Q&A session. But at this stage, I'd love to also hand over to Benjamin Fenger. Ben is the managing partner and founder of SureVest Partners. He's managed over $1.8 billion in Chinese distressed debt and special situation investments, and sits on SureVest Investment Committee. In 2004, Mr. Finger was one of the founders of Shoreline Capital and architected the firm and its strategies. He's been involved in sourcing, analysis, negotiation, restructuring, liquidation related to acquiring and disposing countless distressed assets in China, and has worked directly with Chinese distressed asset sellers, borrowers, judges, government officials related to those investments. He's fluent in spoken and written Chinese for over 20 years and holds a JD and MBA from the University of Chicago. He's a licensed attorney in the state of California. Ben, I know this is going to be a huge ask, but there's so much conjecture about Chinese credit markets. Can you start by just giving us a backdrop and a, if you can, a 5-minute history on the development of the Chinese credit market and how we got to where we are today, before COVID?
Yeah, absolutely. Thanks, Zach. So sort of just as backdrop, there's nothing new about Chinese credit. In fact, it largely predates equity in a sense, because in the 90s, most of the capital that companies in China used to fund themselves were bank loans. So, and that eventually resulted in, the privatization of part of the market. So you had shadow banking that happened after 2012-13. So non-commercial bank lenders. You also have, where we stand today is China is essentially the second largest credit market in the world. There's the second largest bond market in the world. It has the largest banks in the world. So although I think to a kind of a typical allocator into private credit, China might seem like a frontier market or kind of a different or new market, it is absolutely something that can't be ignored. And certainly in other metrics that we would use to measure the size of a credit market, China's one of the largest in the world. In terms of what we've seen on both, and really, I guess, from a private funds perspective, there are two things you could invest in the space. So one is, and this has been happening for over 15 years now, since we started investing in distressed debt and special situations in China. One of those is distressed debt secondaries. So we're buying non-performing loans, and these are generally real estate-backed corporate loans. So loans to companies of every different industry. Could be a textile manufacturer, could be a hotel chain, could be something in natural resources. So all kinds of companies in China use debt to fund themselves, and often that's bank loans, and often those bank loans go into default. So that's one category, essentially secondaries, or the purchase of non-performing loans from the commercial banks in China, which, as I said, we've been doing for a decade and a half now. In that time, probably owned over 15,000 corporate non-performing loans in China. The other side of what can be done in China is more akin to some of what Peter was talking about, which is private credit, direct lending. And this we would call special situations, because in general, there needs to be some kind of a unique situation that means that the company can't get a bank loan. Otherwise, they wouldn't be willing to pay the cost of capital that we would typically require. And so also as backdrop, so what have we seen on these two areas? In 1999, China set up the bad banks to take the bad loans from the commercial banks to help clean up the banking system. That's really when the distressed debt market started in China. And then really it's been a space where people have been investing since what I call the first wave of NPLs, which happened as part of that cleanup, which was probably a couple $100 billion of NPLs that were sold between 2004 and 2008. The second wave of non-performing loans in China came as a result of the massive boom in lending that occurred as a result of the GFC. So China's response to the global financial crisis was to tell all of its banks to lend to every company that moves, whether or not they have a pulse. And then you had a subsequent boom in credit that was unparalleled in the history of the world, at least in terms of speed and scale as a percentage of GDP. And so obviously, anytime you have a massive credit boom like that, eventually you're going to have, that's sowing the seeds of a lot of bad loans to come out eventually. And so China began implementing regulations that were forcing the banks to recognize and sell their bad loans because China has an interest in keeping its banks' balance sheets fairly clean. And that really was through a series of regulations that began in 2015. So regulatory catalysts that forced the banks to recognize and sell their non-performing loans. These were regulations sort of like Circular 46 in 2017, which told the banks, we're going to fine you if you hide your non-performing loans. Also, about a year and a half ago, China redefined what's a non-performing loan as something that's in default for 90 days as opposed to a year. So basically taking the iceberg of non-performing loans and shoving it up above the surface. And so that's really the second wave of non-performing loans. The third is what we're seeing now as a result of the COVID-19 pandemic and the subsequent impact on companies in China. I can get more into detail on that later, but so you had these three waves of NPLs in what is essentially the second largest credit market in the world. So then on the other side, in terms of direct lending, what are the opportunities? And really, there's always been some sort of opportunities. The Chinese commercial banks don't lend in every situation that would make sense from a commercial standpoint or from a credit allocation perspective. And so because of that, there's always been some unique pockets of opportunity. However, between 2014, around 2013, 14, and 15, we saw a pretty big increase in what the news has called the shadow banking system, which is essentially just non-commercial bank lending. And that was things like peer-to-peer lenders. You know, you had Lending Club in the United States, but you had thousands of kind of copycat lending companies in China that were set up to do non-bank lending. You also had the trust companies that were doing raising wealth management products in China to be able to take retail money and put it in direct lending. And so 2015, 16, and 17 was a time when we weren't really focused on special situations or direct lending in China because you had all of this competing capital. You had both the Chinese banks themselves, and then you also had this emergence of a massive wild west of direct lending called the shadow banking system. Well, China reined all of that in post 2017 by implementing regulations that caused the vast majority of those peer-to-peer lenders to shut down. A lot of the trusts that were raising wealth management product capital had to shut down as well. Why is that? Because China does want a credit market to function, work, be enforceable, and so forth. But what they don't want are these sort of Wild West products that raise money from retail investors and then put what in China is called the Laobaixing, or the common people, at risk because their money went into things they don't understand. So we saw that getting reined in a lot in the last few years. So that's kind of a little bit of the backdrop.
That has been incredibly helpful. I mean, summarizing the history of the credit market and how these three waves of NPLs have happened in China in such a short summary. I thank you for doing that. So where are we today? Now, okay, China has had these NPL crises in the past. It responded to the GFC by pumping credit into the system and faced the consequences of that. So they're doing the same today. There's a lot of reports that there's a Lehman moment on the horizon in China, that we're going to face that there's this Chinese debt crisis coming. A few years ago on AIM Summit, we had Kyle Bass talking about China's debt crisis, looming debt crisis. So what are you seeing? You're focused on distressed debt. This is your specialty. This is your territory. When is that Lehman moment going to happen? Is that going to happen? Where are we in this post-COVID environment in China in the credit market?
Yeah, I mean, I don't want to get too argumentative as somebody that has a pessimistic view of China because of the credit markets. But if there was anybody that would be excited about a Lehman moment or the kinds of things that Kyle Bass was talking about, it would be the kind of primary distressed debt investor in China, which is what we are. And the reality is the likelihood of a Lehman moment, I think, is extremely low. And so why is that? So it's not because I agree with the concerns that people have expressed about a large amount of overhang of credit. The Chinese government also sees that, so they're not stupid. They've seen for some time that there's a massive amount of bad debt on the bank's balance sheets. And that's why in January of 2015, I was sitting in Beijing having lunch with one of the directors of the CBRC, which is the regulator of the banks in China, the regulator of the largest banks in the world. And I was having lunch with him and I said, what are you going to do with this massive credit overhang? And I said, you've got three options. There's sort of extend and pretend and ignore it. There's government bailout. He called it 政府买单, which means government pay for lunch. Or the other option is a market-based approach where you have Basel rules or similar rules within China cause banks to take losses, clean up the garbage, clean up the bank's balance sheets. And he said, we're going to do number three. And I kind of laughed and said, yeah, but there's not enough shore vests in the world or in China to be able to digest $2 or $3 trillion of non-performing loans. And besides, the banks are going to try to hide it if you don't kind of crack down on them. And he said, we're going to be investigating the banks. We're going to be forcing them to recognize these bad loans. And we're going to be encouraging a market to exist. So sure enough, following that lunch we had in the subsequent years, we've seen a series of these regulations where the government is doing just that. So since that time, it's usually about $100 or $200 billion of NPLs that get kind of written off and transferred out of the banks every year, which is larger than many countries' entire banking systems. In the last 5 or 6 years, China's recognized at least $1 trillion of NPLs. And so if that's not, aggressive measures to clean up the banks, I don't know what is. Beyond that, they've also, in order to encourage a market to exist, they've also opened up new ways for foreigners to invest, although the kind of Apollos and Oak Trees of the world are not going to be what moves the needle in China. It's really more the local capital flows and investors locally. But they've done things like even as early as with this last trade deal with the United States, if you read down far enough, there's a piece that says, and we're going to allow US, but then eventually this became, in the months following, it became any foreign investor to set up an AMC in China or set up a bad bank that can buy loans directly from the banks. So this, what is China doing? Are they trying to dump their bad loans on unsuspecting foreign investors? Not really. I mean, they're just trying to diversify credit risk across different pockets so that it's not all sitting in the banks. So the good thing about China, and I think this is something that people are probably aware of as they see its response to the health crisis, is that yes, it's not a democracy, but there are certain benefits to that. And probably the primary benefit to that is that you can take very, very quick action when you're not a democracy. And we saw that with the response to the bad loans, this credit overhang. China has actually not followed the COVID crisis with a massive wave of credit. So the US and the stimulus that we've seen in the US dwarfs what China has done. Why has China not responded in that way? Because they don't really want to see a recurrence of the post-GFC massive credit boom. That they don't want to make that mistake twice. They're also only halfway through cleaning up the second wave of NPLs. Why take 4 steps back when you took 3 steps forward? So we definitely are seeing the benefits of a government that can kind of make decisions and have it happen quickly. In terms of COVID-19, we've also seen that. So, the kinds of things that a government needs to be able to address the health situation are, number one, an ability to determine, almost infringe upon what the US might call privacy rights, where who has has a fever when, you know who's been tested when, you know where they go every day for contact tracing. China has all of that. When our team enters and leaves large buildings, they get their temperature taken. It goes through a QR code onto their phone. The government knows, you know, wherever there are fevers at any given time. So that ability is an important piece. Also, the ability to manufacture large amounts of PCR test kits and PPE and so forth. That was, you know, they basically just called up some of the largest medical device manufacturers and had them immediately start producing millions of these things. And so I think, you know, the response to, in an interesting way, the response to the health crisis and the response to this credit crisis have been similar and have highlighted the fact that a government, you know, for all of its shortcomings, you know, one thing that's not a shortcoming is the ability to act quickly to respond. And one other thing I'll say about the idea that there would be a Lehman moment is that China wouldn't let a Lehman moment happen. So what would a Lehman moment be? It would be a situation where the failure of a financial institution within the country causes systemic risk in some way. And we've already seen in the last year, they've stepped in several situations where banks were going to fail. We also saw with Anbang Insurance, which was, you know, one that they had risk across, sort of spread across different products that they had issued. And when China sees that, they step in. And they don't shut the company down, but they make sure that it can continue running in a reasonable way, or in a way that doesn't kind of create a Lehman moment. So I think China is the best positioned of all major countries to handle what's happening right now, as far as I can tell.
Well, so I'm actually going to jump straight into the Q&A because we only have around 23 minutes left in the session, and we have lots of questions coming in. This is a question for both of you. I think I'll start with Peter. So Riyaz Sharif has asked, could you give us a sense where the return potential on private credit deals is that you're seeing today versus where they would need to be to interest you? And actually, I'm going to add to that. If you could kind of walk us backwards through this year, what are the kind of deals that would be of interest to you today? What are the kind of deals that would have been of interest to you, you know, in the middle of the crisis? What would have been of interest to you before the crisis? What's the pricing that you're seeing that you need to be compensated for in your main private credit strategies?
Sure. Well, you know, again, you know, private credit, you know, ranges through, you know, kind of, you know, leverage loans up through direct loans up to, you know, bridge loans, rescue financings, unusual sorts of financings. In the, you know, focusing on the, you know, on sort of the rescue financing, special situations range, I think that, you know, we've certainly seen, you know, spreads have certainly widened a couple hundred basis points, I would say, in some cases more. You know, what we were seeing during the crisis, frankly, was really more so on the secondary side, where you had, you know, for people who were able to be nimble and assess credits and access them, you know, very, very high returns, very high multiples, you know, multiples of 1.2 to 1.4 realized literally within, you know, a month or 6 weeks, et cetera. So very, very high returns in that, you know, in that time period. But, you know, I think, you know, frankly, what we're seeing is the, you know, the types of deals, you know, are still have credit characteristics in the special ops space, but they have more equity-like return. So whereas, you know, our sweet spot was kind of in a mid-teen sort of range, you know, on a blended basis, you know, now it's in the high teens to 20 with a similar sort of collateral package or credit, you know, positioning. So certainly, you know, a bit wider. And again, it's in the context of, you know, of certain markets having rallied very, very significantly on the back of central bank support. So anything that the central banks are buying or literally just say that they're going to buy, you've seen, you know, huge rallies, and you have this real bifurcation in the market, I would say.
Ben, if you could answer the same question, I mean, if you could walk us through what are the types of deals that you look at? How has the crisis changed what you define as an attractive deal?
I mean, for a long time, since we began investing in Chinese credit, the return profile has always, what we've targeted has always been gross returns in the low 20s, and then net in US dollar terms in the mid to high teens. Sometimes if something goes wrong, that ends up being, low teens. I think, and what we've seen over the last few years is, so 2007, so on the direct lending side, 2017, 18, when you had more of the shadow banking system available to companies, the high single digits was what a company would be willing to pay for a senior secured loan backed by real estate. In the years subsequent to that, we saw it come up to low teens and then mid teens and then high teens. And post COVID, what we've looked at is, when I say, senior secured loan, I mean a loan that's backed by buildings, like the buildings you see behind me, that is something less than a 50% loan to value. So very, very heavy collateral coverage. It's 18 to 20% right now. So there's no market in the world where you can charge 18 to 20% return for real estate backed, 50% loan to value real estate backed loans, unless there's, some sort of stress. So it's definitely showing that there's stress. And I think some of that, I think that's largely because it's partly because of COVID. It's also because just China's economy was already decelerating. So there was already an increasing stress for companies. And one other thing I want to say is, we don't just look at what is the return. So what does the number say? The most important thing is the structure of the credit such that we're going to make our money back in basically all cases. And I think this is something that distinguishes a market like China from a market like the US. I mean, we saw direct lending in the US, it was all covenant light. There's way too much money flowing into it. And I feel really bad for people who are in private credit in the United States right now, because if it's a bunch of private credit, covenant light, unsecured deals, something like COVID happens and you're going to be wiped out. Whereas what we mean by private credit in a place like China is 30 to 50% loan to value, so that if real estate markets all decline 25%, we still don't lose capital. That's totally different in terms of risk profile than the United States. So ironically, and maybe counterintuitively, my view is that private credit in China is far safer than the United States, at least if we look at the last 4 or 5 years. And certainly over the history of our business, we've never lost money on an NPL portfolio in 15 years. The legal system does work. You have to understand how to navigate it. But we've been in over 2,000 lawsuits enforcing bad loans in China in the last 15 years, and we would not have gotten into the second if the legal system didn't work to some degree, much less the 2,000th. So it is a space that's hard to navigate, hard to create a capability, but then once you do, I think because of the lower competition and the greater opportunity set, you can structure deals that not just have higher return, but also better collateral coverage.
And that actually leads to a great another question from the audience. Yagub Al-Hadri. Actually, Peter, you had referred to the fact that in Europe, you're seeing more equity-like returns with credit-like risk. Talking about the United States and these cov-lite loans, I think it would almost be fair to say that you're getting credit-like returns with equity-like risk in this highly competitive market. Does this resurgence of cov-lite loans coming back to the market, does that worry you in the United States? Are you seeing the same thing happening in Europe? It would be great to dive deeper into the concerns regarding cov-lite.
Sure. Well, I think so. As it relates to U.S. direct lending, versus Europe, I think I do think in the U.S. market, you had a lot more competition, and ultimately, when you compete, when you're selling money, which is what lending is, You compete on price, you compete on terms, and so leverage is higher, covenants are more under pressure, and as Ben says, when you get a speed bump or a major speed bump like like COVID-19, then that's caused some quite significant losses, and we're certainly seeing private debt portfolios trading on the secondary market at very significant discounts. All you have to do is look at the BDC sector to see that the pain there. My sense is it's not as if there's not cub-like deals in Europe. There certainly are, probably not to the same same extent as we're seeing in the U.S. And again, post-crisis, we're now things kind of get reset. Generally speaking, the best loans that you make are people who are brave enough to come in on the back of a crisis, right? When collateral values come down and pricing improves. So at the moment, covenants are very much back in fashion, and arrangement fees in direct lending are higher and margins are higher. So notwithstanding the fact that buyout activity is certainly still down, and in some markets slower than others. UK obviously late exiting, containment, the return of M&A and buyouts is certainly slower here. So notwithstanding that, there are good lending opportunities, and again, the pricing has improved, and the lender's position is stronger.
So you actually mentioned M&A, and that leads to one of the next questions from our audience. How the decreasing M&A environment is affecting the private credit markets in your markets. Is there going to be another factor that kind of offsets the decrease in M&A deals and helps support increasing demand for private credit? Peter, you alluded to an uptick in secondaries opportunities, but if we could talk a little bit more about how the slowdown in M&A has affected private credit specifically in Europe, and then Ben, for you, the same in China as well.
Sure. Well, I think when it comes to M&A, it tends to slow down when people don't know what the price is, right? So buyers and sellers, of businesses are unclear where pricing is, and here you have this very dramatic impact of the containment measures on revenues in many businesses, and so you would obviously have expected a slowdown as companies are assessing their positions and thinking maybe it's not the right moment to sell, etc. But we have seen activity picking up, and certainly in the countries in Europe that have been opening up, and for the most part opening up, knock on wood, reasonably well. Occasional flare-ups in the virus in particular locales, but generally speaking, it's opening up well, and we would expect activity to return. There's certainly no shortage of dry powder in the buyout space, and so I expect there to be a reasonably quick return of a high level of activity, but again, in the context of a post-COVID pricing with better positioning for lenders than certainly what we were seeing in the period immediately before COVID hit.
Ben, if we maybe just touch upon M&A in China, what's the M&A scene look like there? Are we seeing something similar to what we're seeing in Europe and the United States? And how's that affecting private credit?
Yeah, so M&A has historically been a little bit less of the focus than doing IPOs in China. And what we've seen post-COVID is on the special situations deals we've seen, it's been some years actually since we did a pre-IPO direct lending deal. That it was actually back in 2009 were the last ones we were doing post GFC or during the GFC. And then this year after COVID, we've seen a number of situations where either even a public company that needs a private structured financing, or a company that's going public and needs to bridge a sort of delayed period of time until they can go public. But these kinds of things we're seeing. So I would say that's akin to a situation where you have delayed M&A exit opportunities, and therefore companies need bridge financing. I think that's all normal for these markets and circumstances like this. And to give an example, there was a healthcare device manufacturer that actually manufactures some things used in the fight against the pandemic, exporting a lot of what they produce, and had an IPO that was scheduled for earlier this year, gets delayed. They come to us and say, hey, can you bridge us for 6 months? That creates interesting opportunities for us where you can create some convertibility into that ultimate exit, but at the same time structure it so that there's downside protection, as we always tend to. So yeah, that kind of opportunity does exist today.
One of the reasons that we were so excited to organize this session and really appreciated bringing together Ben with his view in China and Peter with your view in Europe is that while private credit has really surged over recent years, it's been one of the fastest growing alternative asset classes. At the same time, a lot of that focus has been in the U.S., right? And as we mentioned, the U.S. is highly competitive. You're selling money. Talk to us about the competitive environment, because obviously the returns that you guys are talking about are on the deals that you look at are different kind of completely different ballpark than the United States. How is it that you're able, what is it about your particular market in China and Europe that means that you're not competing so competitively, I guess, for providing businesses with capital? Maybe Peter, if you could tell us a little bit about the dynamic in Europe that causes that pricing to be, with banks and providing credit to businesses of all sizes. How are you able to compete with the banks?
Good. That's a great question. Again, I think within private credit, if you're talking about the direct lending, space, that that tends to be a high single-digit sort of business. And I think that's true in Europe the same way it is in the U.S. I think when you get to to more sort of special opportunities ranges is when you're moving into the mid to high teens in Europe. I think part of it is U.S. is certainly the biggest market and very competitive. A lot of smart people, a lot of players, and certainly the scale of the market is such that there is opportunity. Certainly the U.S. has had a bit more of the energy focus and credit, and that's certainly been a rough place to be in the latest period. I think in Europe, I think one of the challenges has always been, and Ben it applies in spades for his market, is it's a little bit harder, right? So you have language barriers, different regulation, different taxation. How you access a market can be a bit more challenging if you're not well connected, if you're not local. So I think those are all things that help you to generate very good risk-adjusted returns, as if you're able to navigate those things. So the closest market to the United States in Europe is the UK, where barriers are quite low. Everyone speaks English. And risk return is lower in the UK than it is in the other markets in which we operate. So I think that's a significant element. I think if you have strong local networks and you have people who can operate in France and Germany, Spain, Italy, Benelux, etc., there are much greater, more material barriers to than there is in the U.S., which is this great big, effectively a great big free trade area with one rule of law and one language and obviously a very large economy. But alongside of the opportunity is just a huge number of competitors.
So a big part of it is that you're compensated for the extra brain damage that you have to take on to go into these markets to deal with these situations. Now, the same question to hand over to Ben, but actually to supplement that, there's a question from my good friend Noor in the audience who's asked about the legal and regulatory framework. You're a lawyer. Your background in distressed credit originated as a practicing lawyer. What is the landscape like in China for enforcing these loans? Is there strong rule of law? What rights do you have? Is there an efficient process, or is it the wild east, if it were?
Yeah, a good way to put it. So I think the answer to that is, first of all, the reason for the higher returns barriers to entry is it's what we do is hard. It's hard, but it's primarily hard at the outset for the first 5-6 years. And then once you have, at least for us, it was 15 years ago, we were kind of running around to all of the banks in China, sort of doing our first, filing our first lawsuits in the legal system. I was first in front of a judge in China in a deal we did in 2005. And he barely knew what a non-performing loan was. So, he was just out of law school. China didn't have a very developed judiciary at the time. And I'm sitting there asking him, let's set the auction date for this building. And he's sort of nervous about what the local government's going to do if he auctions this building. So it's been an evolution. It's been a period of things getting better over time. In January of 2000, so back at that time, 10, 15 years ago, it might take 4, 5, even 6 years to get through the legal process in China. And there were many cases that you just couldn't enforce because there was a lot more influence by local governments. There was more bribery and corruption. Today, it's far better. So it takes generally 18 to 30 months max to get through the legal process. It really does depend on the facts of the particular case, but most of them are pretty straightforward loans that were made by a commercial bank in China or loans that we structured. And I want to say I don't think it's easy for somebody parachuting in from another country. I can't imagine what would be harder. But if you have a platform that's built up over years and doing this one thing, which is buying credit, originating credit, enforcing credit in this one country with one language, with one legal system, you sort of get to know it pretty well. And we've seen among foreigners in competition, we've seen time and time again over the years, people try to kind of parachute in and hire a few local people that, did a Harvard MBA, Chinese that did a Harvard MBA or something, but have no experience in courts in China. And there's such a disconnect. There's such a disconnect between the investment committee sitting in some city in North America and the guys that are actually in China walking around trying to source deals and sort of give recommendations as to what makes sense to buy. Also, the sellers sort of laugh at that. So a Chinese financial institution, if you send in a kind of mid or lower level guy to talk to them about buying some pool of their bad loans, they're going to be extremely offended. But then also, if you bring in some member of the investment committee, a managing director from the United States that doesn't speak Chinese, and you've got to have an interpreter there, you got a zero chance of understanding each other at a level that you need to. So I'm speaking English to you right now. I never speak English on a day-to-day basis. Our entire team is Chinese. And I think if, to the extent that foreigners, start to do it that way, where you're primarily local, I think it's a doable space.
Well, somehow that hour has flown by. We've covered so much ground. We discussed the private credit markets in Europe and in China in the post-COVID environment. We discussed why these markets are more difficult. They're harder to work with. They're harder to, but the benefits of that is that you're not competing with as much capital. You are having to add value to the process and really deliver something to your investors in executing these strategies. We discussed the fiscal response to the COVID crisis, how that's affected the private credit markets. We discussed loan guarantee programs, whether there might be an NPL crisis on the horizon. We discussed, of course, secondaries markets, M&A. We were able to cover so much ground. Unfortunately, there's still 10 questions in the Q&A that I didn't get a chance to get to. I'm so sorry for not being able to get to the questions for those of you that asked. We will do our best to follow up with answers to those questions after the session. I cannot thank you guys enough for participating in this. It's been extremely insightful. I've come out of this with a much better understanding of the lay of the land in Europe, in China in general, but especially post-COVID. I'd like to thank, of course, Hassan Karimi for helping to organize this, the entire team at KHK who made all of this possible, bringing together both SureVest and TKO when they knew that we wanted to do not only a private credit session, but a private credit session that was different, that was where there was real alpha on the table. Of course, thank you so much to TKO Capital for sponsoring this session, to Peter and to Ben for joining us, and hope that you'll all be able to join us for our upcoming webinar happening next week, COVID-19 Accelerating ESG Investment for Resilient and Sustainable Future. That session is going to be sponsored by Apex Fund Services, taking place on 15th of July at 4 p.m. Gulf Standard Time. Looking forward to seeing everyone there. Thank you again, gentlemen. This has been an amazing session. I wish we had more time, but looking forward to speaking to you all again.